ever noticed something strange about the world's greatest investors? The more successful they become, the simpler their investing strategy gets. While millions of people chase the next hot stock, obsess over market predictions, and spend hours glued to financial news, the investors who quietly build extraordinary wealth often do less. That sounds almost backwards, doesn't it? But once you understand the psychology behind it, you'll never look at investing the same way again. Our brains are wired to believe that complicated problems require complicated solutions. In investing, that belief can become expensive. We confuse activity with progress. We think more charts, more indicators, and more market timing will somehow give us an edge. Yet every new piece of information creates another decision, another doubt, another opportunity to second-guess ourselves. Before long, we're suffering from analysis paralysis instead of making thoughtful investments. Behavioral finance has a name for this. It's called the illusion of control, the belief that if we gather enough information, we can predict an unpredictable market. Add overconfidence bias and confirmation bias, and we start searching only for opinions that support what we already believe. Then comes action bias, the irresistible urge to do something simply because doing nothing feels uncomfortable. Ironically, these psychological traps often cause investors to underperform the very market they're trying to outsmart. Now think about Warren Buffett. Despite having access to more information than almost anyone else, he has repeatedly emphasized buying wonderful businesses and holding them for the long term. Charlie Munger often reminded investors that the big money isn't made in the buying or selling, it's made in the waiting. Jack Bogle built an entire investing philosophy around simplicity through low-cost index investing. Peter Lynch encouraged investors to understand businesses they actually know instead of chasing fashionable trends. Different strategies, yes, but one common thread. Simplicity beats unnecessary complexity. Imagine planting a mango tree. You wouldn't dig it up every week to check if the roots are growing. Yet that's exactly what many investors do when they constantly monitor stock prices and react to every headline. Markets rise, markets fall. That's normal. Wealth is usually built by allowing quality investments to compound quietly over years, not by perfectly timing every market move. So what can you do today? First, write down your investment plan before emotions take over. Second, focus on owning quality businesses or diversified funds instead of chasing every market trend. Third, automate your investing whenever possible. Fourth, reduce the financial noise by checking your portfolio less often. And finally, remember that your greatest advantage isn't predicting tomorrow's stock market, it's staying disciplined when everyone else loses theirs. Here's something worth remembering. Complexity often feeds the ego, but simplicity feeds your portfolio. The market doesn't reward the busiest investor, it rewards the patient one. The journey to financial freedom isn't about making hundreds of brilliant decisions. It's about consistently making a few good ones and giving compound investing enough time to work its magic. If this perspective changed the way you think about market timing and investing psychology, subscribe and join me for more conversations exploring the investor mindset, behavioral finance, wealth building, and the timeless principles that successful investors use to stay ahead. Not by doing more, by doing what truly matters.